Well, investors on edge after U.S. stocks reached correction territory on Friday. Now, stocks in China and Europe selling off on Monday. So what does this mean for the Federal Reserve and its looming rate hike? Simon Smith is the chief economist at FxPro and joins me now from London. And Simon, your reaction to what's going on in the markets right now. Do you think this sell-off is caused by China or the Fed or both?
I think it's principally come from China, and within that from their change in the exchange rate that happened earlier in August, and that raised concerns about the potential weaknesses in the China economy. But even before that, we'd already seen a substantial correction in their stock market, which is now down around sort of 38, nearly 40% from the highs seen earlier this year. So China is the principal catalyst. But there are other factors to be thrown in as well, and naturally I think there has been greater concern in regards to the potential for a Fed rate hike and how that might impact the global economy, and I think that's looking more uncertain now as well.
Yeah, I mean, how do you think all of this will affect the Fed's move in September?
Naturally, it makes it more difficult. It's very interesting when you look at the evolution of the Fed. They have become more likely to mention external factors within their statement than perhaps is the case. That's natural. The size of the US economy in relation to the global economy has been reduced from around sort of 30% in 25 years ago to around 20% of global output. So they have to take more account of what's going on overseas. So I think this time, we were seeing a change in expectations even before this latest down move in equities happened. So, as you know, I've sort of been reluctant to see the Fed hiking this year, and I think certainly this moves September off the agenda.
But if we are entering into a global recession, I mean, what is the Fed to do? It already has $4 trillion or more on its balance sheet, and interest rates are near zero. So could we be talking about negative interest rates at some point soon?
I don't know whether we're heading for a global recession at this point in time. You have to look, take a step back. The US economy has done pretty well over the last few years. Job creation has been, in terms of the duration of it, has been at pretty much record levels in the post-war era. So I think in the heat of the moment, we can look at things, think the world's falling apart. It isn't. China is having a wobble in a growth slowdown, which has been underway for some time, but also has been engineered to a degree by the government. They've wanted to see slower growth. They've acknowledged that they can't see the economy continuing at the pace it's seen before, and they have to shift their economy away from investment and more into consumption, which is a multi-year process. So that process will continue, and it's still to offer opportunities for the US and other economies that have exported their, increased exports into China substantially. So what we're seeing at the moment is things in a bump along that road.
All right, let's talk about the dollar. Investors are watching the dollar. It's certainly not too far out of the question to see China devalue its yuan even further, perhaps sometime this week or next week. That would, of course, add steam to the dollar, and that would hurt U.S. companies. So how should investors react to the dollar right now?
It's very interesting because you look at the last few days, naturally you've seen other safe haven assets, be it the Swiss franc, Japanese yen, gold, do relatively well. The dollar hasn't been within that as perhaps you'd have expected in other situations. It has naturally had a role of a safe haven currency, but I think the change in Fed expectations, so investors pricing out the possibility of a near-term cut in increase in interest rates, which would normally help the dollar, has been the dominating factor. Going forward, yes, as you mentioned, a further devaluation of the yuan could help, but I still don't see the dollar behaving in the same safe haven way that we've seen before, as it did very substantially back in 2008. So I think the currency markets are playing this differently. They're not using the dollar as a safe haven as it was done before.
All right, Simon, we'll leave it there. Simon Smith, the chief economist at FxPro, thanks very much for joining us from London. I'm Scott Gamm, and you're watching The Street.